that will be a much easier part. So that's all about this charts. Hello, welcome to our next schedule and last schedule of this basic course. In this schedule, we're going to learn about the psychology of the traders and general effects we have. This is known as a trading psychology. It is very important for all to learn this because it is inbuilt. We have this psychology. This trading psychology is the most influencing factor and the most deciding factor in our trading journey or in our investment journey, because it will turn our huge profits to a minimal or even loss side also, or it will just it makes the reverse of our what is get the benefits of market. So most of the losers in the market are generally effectors of the trading psychology. So initially we lose this, and initially everyone will get these psychological effects, because I am the one of the sufferer of these things, because if we keep on understanding is very much important of these parts and how they are going to affect us. And I thanks to many people who given me a good ideology on that and who guided me how to overcome all those things. At the end of the classes I will give you some tips on that, and I will give you some groups also where you can join and you can get those parts. For this to overcoming and everything, to keep ourselves silence, I recommend going with something like a meditation or some whatever you feel good, you can go for that. Or you can keep silence. What generally I will do is I will keep silence before I do the trading, and I will take deep breaths and before I decide anything, to calm down my tension, or to calm down my nervousness, or to calm down my institutional decision making things and everything. So you will have such effects also. So let's us learn about what are the things we'll face in the trading. So in this image you can see, I explained this. This is I collected from netdnssl.com. I am giving credit to them also directly because they have explained it such a beautiful image within a beautiful image. See what is this, and whatever the methodologies we have, whatever the strategies we have, it is only gives us the 15% of our journey. But when we go deep into this, the risk management and money management will decides our 35% of the trade, and 50% is a discipline, emotional control. 50% of the this will decides our goes out to discipline, emotional control, self control, and patience. See, this is the iceberg of our trading success. So always believe that if you have good discipline and emotional controls and risk management, even if you don't have a good strategy also, you will come up with a good profits, because of your discipline and emotional controls and money management, that gives us a that will convert our poor results into a good results. And if we have any a very good strategy, then I always bet on that. Yes, there is no one can stop you on your successful trade. So even if you think you had found the holy grail of forecasting methods, chances are you have barely scratched the surface. Means, see, if you have a holy grail that this is gonna crack the market and everything, that's only gives you 15% of success. So other 85% will be disciplined, your discipline and your emotional control and your money management techniques only gives will decides us that. So we look till now we have what we have learned is of about that 15%. In the next simple slides I am going to explain this 85%, but I can only explain you this part. In 35% part I can help you out on risk management and money management techniques, which I'll give you some links also where we can assess your risk profiling and everything. But I will explain this only. I can only explain your 50% of this emotional control, self-control things, but I can't help you out on overcoming that, because yourself has to fight back and you have to get those controls. So as you can relate to the above stock above image, as I explained how important the stock market participants to take care of their psychology. So you have observed that 85% of your psychology and management money management techniques only decides our success ratio. See, trading psychology generally refers to our emotional and mental state, which helps us in success failures in the trading securities, which is given by the Investopedia. So it is in every platform, also in every place. If you type about this trading psychology, you will get the same definitions, or even everyone explains the thing. So each and every successful trader or an investor has a good trading discipline. So because it is a trade plan, because trade plan is very much important before entering into the market. In that we'll decide our discipline, what is our risk taking capacity, and etc. So what's our biggest enemy? Our biggest enemy is greed. Greed means uh, greed is nothing but if the price is at 100 rupees, and if you think want to close, it goes to 1 or 2 rupees, and once the market is start moving to 103, suddenly it's moved to 103. What you will think is yeah, the price will now move to 105. So you will keep on uh, hold on to that, and suddenly what happens after 103, it will fall back to 99 rupees, suppose to 99 rupees. What we'll do this, what we'll believe is if such big movement is happened, so we'll think that we'll erase all our trading plan and everything, and we'll think that I am having 1 rupee loss now. So before actually I had 3 rupees. So you believe that you had done a mistake, that not closed your trade into 103. So what will you keep on holding to that such stock till it again you'll try to convince yourself that the stock will comes to 100 rupees, and then your mind will say don't close at 99, the stock will come to 100, so we'll close at 100. So once the stock comes to 100, then again your mind dictates you to keep hold to that. See, now the market has retained, so now it will come to 102. So we keep ourselves satisfying ourselves by not closing the trade. Even if we define that if the price touches 109, we have to close the stock. If it is touching 102, we have to get out of the with that profit. Even we have such definitions defined ourselves with our strategy, we won't exit, because of the moment which is we're seeing in the market. Our mind will play a game with ourselves. So this is a loss aversion. Means loss aversion bias means it is a very big painful, and it's very much every investor and trader has to face this, because it's investors tendency to strongly prefer avoiding losses to acquiring gains. Means we always love the profits, but we can't take the pain of loss. Means if we get 105 rupees 5 rupees as a profit, the joy of that will be just vanished if we have a loss of 1 or 2 rupees loss, because we have lost 2 rupees, which is a very strong effect. It will show us a strong effect, and it will affect our even our next decision in the trade, taking the trade. So which is very much important to understand that. So bearing the loss is shows a major effect, major it shows not a major, it shows a very higher effect on our psychology and our next trading plans also. So what we'll do is automatically we tend to move to the we'll become ourselves more resistance to the losses, and we can't take the uh, pain of loss continuously. If we hit 1 2 3 uh, trades in a loss, that will blow your mind very strongly, even the loss is very minimal also. Even you have one trade as in a good profit also, that will affect much on your psychology. So instincts are another trading block, like I explained before. uh, the moment such moments will keeps our instincts provoking that close the trade, or keep the trade, or close the trade. Even it will always keeps ourselves deviating from our trading plan, or as per our trading strategy which we have defined for ourselves to get good profits. So we see the confirmation bias also is there. Confirmation is bias is nothing but uh, we'll search for the confirmation which supports our beliefs. Means if we think the scripts is going uptrend, and we'll always try to select indicators which shows that it is going in uptrend, and after enter will affect with either instinct or greed based on movement of the stock. So we'll select such stocks, such indicators, and we'll apply them, and we'll keep on changing them till it supports our belief that the stock is going to this way or this trend. I mean the uptrend or downtrend. And then what we'll do is we'll select such stocks or such indicators, and our mind keeps saying that yes, your belief is right now, so enter into it. Once we enter it, and again the same which I explained, instinct or greed based, or other confirmation bias effects, I mean sorry, not confirmation bias, loss aversion bias, all these again starts coming to effect, and it will affects our trading plans or our trading journey. So again apart from this confirmation bias, we have an generally this confirmation bias will have in both traders and support, I mean long-term investors also, because we will always search for, in investors they always search for the stocks that which believes that they select a stock, and they will try to identify the information which supports their decision that they are buy the right stock, but only, and they will excuse themselves that the market has given a bad effect only the stock, but even their decision is correct and stock is moved only wrong side because of market corrections. They believe such information only. That's very dangerous. So in the confirmation bias will, it's very dangerous in the terms of long-term investments also. So next coming to another psychological effect is endowment effect. In this general it is more in the investors. Endowment effect means uh, they will hold some stock like TCS. If I hold TCS stocks, even if it is going a negative side, because I can't leave such stock, because I'll feel the ownership on that particular stock, and I can't leave such stock. I keep myself to take the information from the market that this is my decision to support myself, my decision that holding that stock is correct, because it is only due to market corrections. Like it's like a confirmation bias after buying. If we are keep holding to the stock even it is showing a negative effect, or it is based on the strategies, if it is showing a negative effect coming up, and if we can't leave such stock, and if we are keep on holding that, no, this stock is going to perform because I have information, which we believe that information is there, is correct, which because we'll search for such information only uh, due to this effect. It will happen unknowingly also even, but we have to understand ourselves, is very much needed. So next, coming after that, we have an anchoring effect. Means anchoring effect means we'll keep first piece of information means we'll search one decision, one information, and we'll keep believe that that information is true, and we'll keep decisions on that. But while implementing it in the market, that information may be become expired, or become that information has no, may not have impact in the market at that particular time, because that may be a previous information. So but will, so that such informations, and if we believe strongly that that information is correct, which is not relevant, or which is may not be a right time to make a decision on such informations, is called as an anchoring effect. So it generally will have this in the investors, most new investors, this anchoring effect will be there. So we have to keep mind this also. We have an winner's curse of thing, means this is a very much important, friends, to understand this tendency to make sure that a competitive bid is won even after overpaying for the asset. Means if we think that stock is price holding at 100 rupees, but the actual value may not be go beyond 80 rupees, but what we'll do is we keep on we'll see that demand is increasing because it's reached 100, because the demand is there, and we believe in such thing, and we'll take it as a prestige to hold that such stocks, and we keep on bidding on that more than its value, just to win it, because we'll keep that as a winner pride with ourselves by even by overpaying it. So this is also a very important part. This will not this will affect winners curse, will affects us in not in investments, in not only in our stock market, or even in real estate, or wherever you are going to for your investments, or wherever in the in a business. We should not have this mindset of owning a particular thing, and we should not overpay for that particular asset, which may not give a good returns, or which may not be a that much value in the, which is not having a such huge value in the market. Means like if we are buying an asset, say worth of 1,000 rupees, and if two three or persons are competing for that, and if the price, you know that if you sell that particular asset, you will get another, you will get only 1,000 rupees. So it is always ideally good, should not go beyond the 1,000 rupees, which will not give an even a loss or profit on that. So that is the maximum limit which we can extend, but to warn it, if you think that no, I should warn it this at any cost, because other two are participating, I want to be on the top hand, and if we think if we go beyond 1,000 rupees, even 1 rupee, it is a loss. So at the end of the thing you won it, but you are in a loss. So that's effect is known as a winner's curse. So we have to keep mind in this also. So it is a financially loss thing. We have another thing known as a herd mentality. It is a common behavior disorder in investment community. It is an outcome of uncertainty and belief that others may have a better information, because it's like we believe that I have a you believe always believe that I have a good investment ideology, so you always believe that I have a good information, and what I'm doing is a good, but that's not correct in the market, because always we have to decide a particular stock or particular investments based on our risk profile. I have to invest on based on my risk appetite, my risk profiling, my ideology, my goals, because without because mine and yours financial goals will be differ. My financial strength will be, and your financial strength, your incomes and my income, your expenses and my expenses are always quite different. But even if you select a stock that selected TCS, means that's not a good idea, because you have to select TCS only when you believe that that sector will be performing, or you have an good interest on it. So you have to select based on different factors only, you have to select. So that's how this head mentalities will decide thing. So we have to come out of this head mentality. So means if we buy which leads to investors to follow the investment choices that others makes. Such choices may seems right and even be justified by short-term performances. See, sometimes if you take follow them, and sometimes you may get the good performance reports in the shorter term, but in the longer term it may not give you the thing, and if some bubbling is there and it's pop outs, then it crashes back, so which will affect our financially. Apart from this head mentalities, we have another thing is called projection bias. Projection bias means we'll take the recent events and will predict the very distant future by ignoring the distance past. Means we'll don't consider a very distant past from the uh, particular company, and we'll think that latest performance is very good. So if we see the charts, we're getting a 5 years charts, and if the company is not performing in the last 4 financial years, and if it is performing now, what will if we consider this particular year as a performance, a good performance, and if we project that in another coming 5 years this stock gonna perform, gonna rock, and if we invest in such things, that is called as a projection bias. Means we are completely ignoring previous 4 years, and we are taking only considers latest performing year, and if we take decision on such things, then it is known as a projection bias. So this is also to be a considered point. And next after this psychologist, we have an risk management. It is the plan which we need to develop based on our capacity to hold the loss. Means if every 100 rupees I can loss up to 20 rupees, means 20% drag in the my investment I can hold. So if I can hold up to 20%, based on that I have to design my strategy. So I should not lose at any point of time more than 20% of my investment. So some may go up to 15%, some may go up to 10%, some may only go for 5%. So it depends upon individuals risk, right? Uh, I may lose up to 100, even 100%. If I may lose, it may not affect me, but for you losing 5% may affect you. But some other person in the group may lose up to 50%, because it may not affect because he has some other sources of income or some other things. So based on that he will go for the is a risk profiling, and based on that he will build his strategy. So if say if a trader X can bear a loss of 1% on his capital invested, based on that he designs his strategy. So if I am a trader and I can bear the loss of 10%, so I have to design my strategy, because I have to, because on a overall performance of my investment or my trading should not go beyond 10% of my total investment. So at any point of time, if I invested 1 lakh in the trading day and I buy 10 different stocks, so overall loss of that complete day I have invested 1 lakh, and my risk profile is 10% saying. So if the loss is touching 10% in any particular single stock or in any overall of the particular thing, so I should come out of the market. So this has to be designed very carefully, and this is very much important. This is where we'll get the money management techniques and the risk management. So our strategy will be based on this risk profile. Will decide our both entry and exit points, means we'll define our stop loss and everything. As I explained before, see there is in a bracket order. If we remember, we have an thing, we have to give these many points, or 10 points or 20 points I am ready to lose, means for every stock 10 rupees I am going to lose. So that based on this percentage we'll decide that price, that points, and if we can go that, you'll get a good decisions on that, and we'll get a good profits. So for this we have to learn about the risk reward ratio, which is important of the plan. So risk reward ratio, what is the risk reward ratio? Risk reward ratio is a tool we use to address our risks. Means, as I explained before, for every 1 rupee loss is my risk in every trade. So example, as I said 10% is my risk. So for every 100 rupees, 10 rupees is my risk. So I defined my risk side. So how much is the profit I have to take? That is also very much important, because if you are not defined your goal, if you are not defined your destination, how can we expect reach the destination, right? We know the starting point, we know the maximum we can go back, to which village we can go back, and if we don't know the destination, how can we decide ourselves to which bus we have to board and how to go and everything, right? So for that, the destination should be defined before itself, right? Going out and catching a bus, we have to define ourselves our destination, right? So that's how we have to define our reward also. So for example, if trader X risk reward ratio is 2:1, means he is risking 1 rupee for every 2 rupees profit, means I am ready to lose 1 rupee, yeah, because so I'll keep my stop loss till 1 rupee, and I'll keep my profit level at 2 rupees. If market is touching giving me a profit of 2 rupees, then I will come out of the trade. Even the market is going at 5 rupees also profit, no, I have to come out of that. Here this is where our psychology and our decision making will helps us, which means for see, if with this ratio, for every 10 trades, if we hit 50%, just 50% success rate, imagine how much we'll get. 50% means for every 10 trades it's a 5 trades. For every 5 trades we got 2 rupees profit, means 10 rupees as our profit, and in 5 trades we lose 5 rupees, means 5 trades into 1 rupee loss. means 5 rupees. So out of 10 rupees profit, we have lost another 5 rupees, which is giving an 5%, mean 5 rupees profit, right? Still we are in a profit. So out of 10 he lost 5 trades, which is 5, and made a profit of 10 in another 5 trades, which is equal to 5 rupees. So as a total, even in his 50% success, he is in a profit. So let's see if your strategy is powerful enough. See, if we have a good strategy and which is powerful enough, 3:1 or even 5:1 risk reward ratios are used in the market, but as an entrant, 2:1 is a good, and if we after developing a pro trader, we can go up to the 5:1 also. I'm going at 3:1, 4:1 ratios as of now. Most of the people, I am not, my strategies are not strong enough to give at a 5:1 ratio, but my strategy is very good at a 3:1. It performs at good success ratio. It is giving at a 50-60% success ratio, so which gives me a good profit. So imagine if 3:1 is my success ratio, if I am hitting 50% times, 5 3 is a 15, it is a 15 rupees profit, and 5 times I lost as 5 rupees, which gives me, which is providing me a 10%, 10 rupees as a my profit. So imagine if what will happen if it is a with a 5:1 ratio. So risk reward ratio must included in our strategy. So based on that, we have to stick to our plan. So with the risk reward ratio, we define our entry and exit points. With our trading strategy, means with our indicators or whatever thing will decides our when to enter and when to exit. Exit already will get that through this risk reward ratio, right? But when to enter is decided with our strategy. So by this, and what happens with the psychology, if we sticking to our exit with as defined based on this risk reward, and if we are exiting, then we have overcome our trading psychology. So if we overcome all these three things, if we cover up all these three things, I think you got the point. Yes, we are in good success ratio. So we'll so to define our risk, we need some tools. I'll give you the in the end of this chapter, I'll give you some uh, links where we can get our risk profiling. So we'll go with the checklist. Where is the entry point for the trade? Where do I place the stop loss? With risk reward ratios, we'll get for where we have to place the stop loss. Entry point of the trade will get with our strategy. Where does the profit target goes to this for this trade is based on our strategy, based on our it will indicate, it will gives our good profit points. So based on our risk profiling and risk reward ratio, and combining with our strategy, we will define go for either 2:1 or 3:1 strategy success with a risk reward ratio of we'll choose based on our strategy, right? Once we define all these things, we'll calculate the risk reward ratios. Yes, by going this we'll get the true risk reward of the trade. So even with a smaller loss, we'll get a good profits. So but to mention it, never change your risk reward ratio once you entered into the trade. So that will nothing but a psychological effect which is affecting our trade, and I will surely say that it will directly, it shows a direct effect on your, you may win as initially, you may win some trades, 1 or 2 trades or 5, sometimes lucky, damn lucky, you may win 10 trades or 15 trades, but not always that luck will favor you. Even one blow will drag you out of the market. So please always remember friends, This reward ratio is very much important and never change once. And if you are entering a market and if you are trading, if you open the trade with some risk reward ratio and based on some strategy, and never change that till you exit the trade. That's very much important to get a good profits. So this is a risk profiling. It is a tool which helps us to assess our risk capacities. Means how much we can lose based on it based on our some questions will be there. So I have given ICICI tools planner in which the risk profiling tool is there. We have in Money Control, which is a very good site, as I shown before. They also has some risk assessment tools. If you can go into Google, you can get uh, n number of risk profiling tools, but Money Control and ICICI Prudentials will giving you a very good insight into our risk appetite. So I used to my clients both the tools so that they will understand the basic risk profiling. If you are not defining, if you can't define yourself, even if you can define yourself also, I recommend to go with these tools first, so you'll get a basic idea about the your risk appetite. Maybe based on some questions you may get a good insight of your risk things. So that concludes our course, I think. So if you have any queries on all these courses and everything, you can always feel free to ask questions uh, in the question answer sections, and I'll try to make that thing. As I explained, I'll try to provide some good books to you to get a good understanding of the market. I thank you all, each and everyone, for subscribing my course. I always welcome you on my discussion group in WhatsApp and Telegram. Soon I will transfer all you to my Telegram channel also. So please kindly who are in the Telegram channel can join me there. In that almost every even any course also members will be joined there itself, and it's a single group. I'll make it as a single group. So we'll all have a good trading journey there. You can always email me your questions and everything on admin@sgrraju.com. It's my private mail, so I try to answer it as early as possible if I get any mails. So okay, this is a swing trading advisory channel. I'm going to start soon. So that's all the details, and I will explain it in the future discussions. I thank you all, and have a happy trading journey. Let's rock.